Chapter 14, Real Estate Closings. This is my favorite time of the day, I've got to tell you. The closing is when there's an exchange for a deed for money. It's when everything's settled up. And what we're going to talk about right now are pre-closing activities, post-closing activities. What do we need to know in order to make this closing a success? In your textbook on 14.2 and 3, just remember that there's going to be some commissions paid. You're going to need to know how to calculate your commissions from a testing standpoint. But my suspect is that once you get into business, you'll know how to calculate your commission in your head, I promise you. In fact, somebody calls and they want to see a property, you'll start immediately thinking, let's see, what's my commission? You'll have it calculated and spent before you ever get in the car with them. So let's just talk about the sales commissions. Just remember that the way a commission works is the commission belongs to the broker, and oftentimes the broker has a relationship with the sales associate where they split a commission. And we're not going to get too complicated in the testing. The broker may get 50%, the sales associate gets 50%. The broker may get 40%, the sales associate may get 60%. So just remember the total commission has got to be 100% of whatever that is. And make sure we keep our eye on the ball in terms of who's receiving what. And at the top of page 14.3, there's a great example of a good commission problem. So I want you to take a look at that. Some of the other things about a closing, and I think it's important for you to understand that when a property goes under contract, a buyer and seller has a meeting of the minds. That property is not sold at that moment. A property is not actually sold until it goes to the closing table. The deed is delivered for money. And as we mentioned earlier, actual notice, title transfers when that deed is delivered and accepted. It's delivered from the grantor and received by the grantee. Title has transferred. So what are some of the things that we have to keep our eye on the ball? Appraisals have to be done, surveys have to be done, termite inspections have to be done, sometimes home inspections have to be done, and we have to stay in touch with a lender to make sure that that mortgage is moving through the system the way that it's supposed to. And then we also have to know who that closing agent is. And it all has to come together at one time, and hopefully it's going to be a successful closing. What I want to do right now is I want to talk to you about expenses and prorations, because these are the things that you're going to need to understand when you're dealing with buyers and sellers. First of all, a proration is an item that is shared between the buyer and the seller at closing. Real estate taxes are a great example. If the property is a rental property and you're closing in the middle of the month, the rent could be a proration. If there's an assumption and there's interest involved, interest could be a proration. So a proration is an item that both the buyer and seller get to share. An expense item, on the other hand, is an item that we pay to people outside of closing. We call those third-party individuals. For instance, it's money that we pay to a surveyor, to a home inspector, to a real estate broker, to the state of Florida. It could be any number of individuals or companies that are outside of closing that we have to pay. Now, what's the difference? In a proration, that proration will be a credit to one party and a debit to the other because it's shared. An expense item will always be a debit only. So let's narrow this down. So if it's an expense item, it's always going to be a check written to somebody outside of closing. A proration is going to be a bill that the buyer and seller are going to split, and chances are one party's either already paid it or will have to pay the whole thing later. Remember that a proration is a single amount of money that one person is going to be paying to another. One amount of money that one person is paying to another. And if you'll take a look in your book, we've got rent prorations and we've got tax prorations. It's all covered here. But here's what I want you to remember about a proration. Here's exactly what I want you to do. And don't deviate. When you're doing a proration, the very first thing that I want you to do is, first of all, say, is this a 365 method or is this a 360 method? What I'm saying is the 365 method means there's 365 days in the year. Unless the test question tells you differently, it's going to be the 365 method. That means that every month has a number of days that it's supposed to have in it. January 31, February 28, March 31, and so on. So you'll need to know the number of days in each and every month. Secondly, you need to identify who does the day of closing belong to. It cannot belong to both. And what I mean is, if it belongs to the seller, that means the seller gets to keep any kind of income coming in, but the seller also is responsible for any bills that have to be paid. If the day of closing belongs to the buyer, same goes for that person. Income's theirs, bills are also theirs. So we have to identify who the day of closing belongs to. The next thing that I want you to do is draw a timeline. The seller is going to own the front side, the buyer is going to own the back side. And what I want you to do is mark that day of closing on that timeline, somewhere between the two. And then I want you to mark on the front side for the seller, or the back side where the buyer is. When is this bill either due or paid? If it's a real estate tax bill, it's paid in arrears. It's paid at the end of the year. Mark it. Put a dollar mark at the end of the year. If it's rent, it's going to be paid up front. Well, put a dollar mark up front. Now we've identified when that money is either due or payable. Because here's what we're going to do. We're going to take that mark, wherever that money is due or payable, and we're going to walk down the timeline to the day of closing. Because what we're looking for is not the front side of that, we're looking for the back side of that timeline. Because that will be the money that's going to be paid from one party to the other. If it's paid in arrears, start at the back of the timeline, walk down it to the day of closing, because now we're going to be looking for that other side from the date that that was paid. Example, taxes are paid in arrears. If you're looking at a June closing, you walk down to June because you're going to be looking from January to June. And since the bill has not been paid yet, that buyer's got to pay the entire tax tab at the end of the year. If you're the buyer, that's not fair. So what you want to do is say, Mr. and Mrs. Seller, you owe me real estate taxes from January 1st to June 30th, whatever that date is. At closing, the seller is going to write a check to the buyer in that amount. It'll be a debit to the seller, a credit to the buyer. If it's a rent proration, remember that rent's paid up front. Get on that timeline. Walk down to the day of closing. Because rent's paid monthly, you're going to be dealing with a particular month. How many days are in that month? Find out what the day of closing is and who it belongs to. Because the bottom line is the seller has already collected all of that rent money. They put it in their pocket. If you're the buyer, you're saying, wait a minute, I'm going to own this property after closing, and I've got to manage it. That portion I deserve. So the seller at closing is going to write a check to the buyer from the day of closing to the end of the month. So the deal is this. If the bill is due or paid up front, look to the rear of the closing date. If the bill is paid or due at the end of the time frame, go down to the closing and you're looking for the front. If it's paid in front, look to the rear. If it's paid in the rear, look to the front. That rule of thumb does not change, and that's how we do prorations. Another aspect of closing that you're going to have to know, there are going to be transfer taxes. Transfer taxes have to do with paying the state for real estate closings and mortgage closings. Remember, at a closing, there's typically two closings at the same time. A transactional closing, which is deed for money, but typically before you can have that closing, there's going to have to be a loan closing. In other words, the borrower has got to go to the bank, and the bank has got to give them money. So there's two separate views of this. First of all, there's going to be a documentary stamp on the deed. That documentary stamp on the deed is typically paid by the seller, and it's based on the purchase price. Whether it's a cash deal or financing, it doesn't matter. It still has to be paid. And the calculation for that is easy. You're going to take the purchase price, you're going to put it in your computer, and you're going to divide it by 100. See what your screen says. As long as it's 0.00000, all you have to do at that point is multiply times 70 cents. But if there's any fractions in your screen from the point, and it'll all show up in your $10 column, like the purchase price is $75,750. Well, that 50 creates a rounding when you divide it by 100. You have to pull that out and round it up to the next nearest 100. Then multiply it times 70 cents. Oftentimes the borrower has got to get a loan. And let me tell you, that loan is going to carry two documents. It's going to carry a mortgage and a note. The mortgage is collateral. That mortgage has to be recorded on public record. It's considered to be an intangible item. Therefore, there's an intangible tax on the mortgage. That amount is 2 mils. 2 mils is 0.002 times whatever that mortgage amount is. And always remember that a mortgage, since it's a collateral instrument, cannot exist unless there is a debt instrument. That's your promissory note. So with every mortgage, there's a note. That promissory note is going to carry a stamp also, 35 cents for every unit of $100. Once again, just like the deed, you're going to take that note price, divide it by $100, and see what's in your calculator. As long as there's no fractions, multiply it times 35 cents. But if there's any fractions, you've got to stop it there, pull it out, and round it up to the next nearest 100, then multiply it times 35 cents. Remember that intangible tax and dock stamps on the note are typically paid by the buyer. It's not in concrete, but that's how it's typically done. Those are going to be your taxes that are going to be due at closing. You're going to need to know how to work those. Now, there are some rules of thumb about who pays what and how these things are debits and credits on the closing statement. Let me start with the purchase price, and I want you to think through this. A debit is any time that we have to pay money or we don't get money. A credit is any time that we either receive money or don't have to pay money. An easy way to remember that is a debit is a sad face, a credit is a happy face. It's that simple. So a purchase price, the buyer is writing a check to the seller. Sad face to buyer, happy face to seller. Debit to buyer, credit to seller. An earnest money deposit. That buyer did not give that deposit to the seller. They gave it to a broker to hold it in trust until the day of closing. That means that's money that the buyer does not have to come up with at closing. That's a happy face for the buyer, but it only applies to the buyer. So it's a credit to the buyer. Earnest money deposit, happy face, credit to buyer only. Now, mortgages. Mortgages are a debt. And the way we see this for sellers, that when a seller sells a home and they still owe the lender money, that's money they will not get at closing. Sad face. So all mortgages are going to be a debit to the seller. Even if a seller does owner financing, it's still money they don't get at closing. Sad face, debit. On the other hand, for buyers, if a buyer can obtain a loan, that's money they do not have to come up with at closing. That's a happy face. That's a credit. And if they can assume a debt or get the seller to do financing, it's still a happy face for the buyer. Now, it's going to be a sad face for the seller. So just remember that all mortgages, as it relates to the seller, debit. All mortgages having to do with the buyer is going to be a credit. And that's the easiest rule of thumb that you can have about a closing. You need to look at this section. There's some good information. You're not going to have a lot of questions on it, but I promise you, on my exam and estate, you're going to have at least 2 prorations that you're going to have to do. And you're also going to have to calculate those closing doc stamps and tangible tax that are going to be required at closing. So you're going to need to understand what that information is. And that's all I've got for Chapter 14's closing section. So I'm going to go ahead right now and move on into the review of that section to make sure we understand exactly what we need to know. Chapter 14, Closing Review. A debit is money that is owed. A credit is money that is received. A proration is an item shared between the buyer and seller. It'll be a debit to one and a credit to the other. Expenses are monies owed outside of closing. This will be a debit only on the closing statement. The documentary stamp on the deed is based on the purchase price, and it's 70 cents for every unit of $100. And remember, any fraction you have to round up. The documentary stamp on the promissory note is 35 cents for every unit of $100. And remember again, any fractions you have to round up. If you'll notice, the doc stamp on the deed is twice the cost of the doc stamp on the note, 70 cents versus 35 cents. The intangible tax is based on the new mortgage. That's 2 mills times whatever that new debt is. Mortgages are always a debit to the seller and a credit to the buyer. And that's all I have for my review for Chapter 14.